Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first Fed cuts rates amid a job slump, revealing a deeply fractured committee under siege from political pressure. We'll examine how this internal division and political pressure complicates Fed policy and threatens market stability. Second, UK's 5.1% food price surge makes it a European inflation outlier, pitting government policy against the Bank of England. Today, we'll take a closer look at this policy clash and its implications for the Bank of England's interest rate path. Third, billionaire Jeffrey Gundlach predicts $4,000 gold, urging a radical 25% portfolio allocation that defies traditional 60-40 strategies. So we'll discuss why he sees a perfect storm from de-dollarization and Fed easing and what it means for investors. The Federal Reserve just cut interest rates for the first time since last December, but this isn't a victory lap. It's a warning shot fired over a stalling US economy. A while back, we asked whether the Fed would cut to support a healthy rotation or hit the panic button to prevent a downturn. The latest move looks a lot like the latter. This move was triggered by a chilling signal from the job market. After months of weakness, the US economy reported an outright loss of jobs in June, the first such decline since 2020. Continuing our last discussion about those big downward revisions to payroll data and the real-time warnings from bank data that hiring was slowing, the solid labour market we were told about now looks like it had cracks all along. Actually, economists are worried that the labour market might be past a cyclical tipping point. This is where the situation takes a more complex turn. There's an indicator called the SARM rule, which has historically been very accurate at spotting the start of a recession. It triggers when the 3-month average unemployment rate rises by 0.5 percentage point from its low over the past year. Recent data shows we are already more than halfway to that threshold. According to one senior economist, the Fed knows that when the labour market turns, it turns very quickly, and they are trying to get ahead of a potential collapse. This suggests the Fed's main focus has pivoted from fighting inflation to preventing a sharp rise in unemployment, meaning they have a lower threshold for cutting rates again if job data continues to soften. But that's not the whole picture. The decision to cut rates by 0.25 percentage points has exposed a deep fracture within the Fed itself. The vote was 11-1, with the lone dissenter pushing for a much larger half-point cut. We previously noted Governor Waller opening the door to exactly that kind of move if conditions deteriorated. Today's dissent lands squarely in that camp. Forecasts from inside the committee are now all over the map. 7 members believe no further cuts are needed this year. Meanwhile, one member thinks the rate should plummet below 3%. And, this disagreement is laid bare for all to see in what's called the dot plot. This is a chart released by the Fed showing where each member individually thinks interest rates should be in the future. The widespread in these dots signals deep internal confusion and a lack of consensus. We previously analysed how a scattered dot plot would complicate forward guidance. The latest one does exactly that. The reason this is such a big deal is that a predictable Federal Reserve is crucial for economic stability. When the Fed itself is divided, it creates uncertainty for businesses and investors, making it much harder for them to make long-term decisions about hiring and investment. This internal battle is happening under a full-blown political siege. However, if you zoom out, you'll see another layer of strategy at play. This sustained political pressure threatens the very foundation of the Fed's credibility. For decades, the Fed's independence from politics has been a cornerstone of the US economy's strength and the dollar's status as the world's reserve currency. If markets begin to believe the Fed is making decisions based on political pressure rather than economic data, it could unanchor long-term inflation expectations. This would force investors to demand higher interest rates on US government debt to compensate for the added risk, ultimately raising borrowing costs for everyone. President Trump has spent months publicly blasting the Fed, calling Chairman Jerome Powell a real dummy on social media and demanding rates be slashed to as low as 1%. His administration even rushed to install a new board member just in time for this week's vote. Caught between a weakening economy and intense political pressure, Chairman Powell himself captured the extraordinary tension, admitting to the press there are no risk-free paths right now. The rate cut is now official, but the real story is the war being waged over the future of the US economy. This decision reveals a Federal Reserve caught in a vice grip, squeezed by alarming economic data on one side and an unprecedented political campaign on the other, forcing it to navigate a crisis with a deeply divided crew. A few days ago, we said markets were already screaming that a cut was a done deal. Now the question is whether the Fed sticks with smaller steps or reaches for a bigger move if jobs data worsens. So what's next? All eyes will be on the upcoming monthly jobs reports. Any further signs of weakness could force the Fed into more aggressive cuts. For markets, this shift toward easier money is generally a tailwind for stocks, as lower rates reduce borrowing costs for companies. However, it also puts downward pressure on the US dollar and pushes up the price of assets like bonds and gold. The path forward remains highly uncertain. The Fed is walking a tightrope in the US, but it's not the only central bank in a difficult spot. Over in the UK, the problem isn't a slowing economy, but stubbornly high inflation, especially when it comes to groceries. While inflation in France sits at just 0.8%, Britain has become a major outlier. The UK's overall inflation is stuck at 3.8%, but the real story is what's happening at the grocery store. Now, get this divergence isn't random. Much of the UK's inflation problem appears to be homemade, driven by factors unique to its own economy, setting it apart from its European neighbours. Food and drink prices just surged by 5.1%, their highest annual rate in 19 months. We're talking about beef and veal prices up nearly 25% in a year. Butter is up almost 19%, and the price of chocolate has jumped over 15%. And this isn't just a number on a page. One bakery owner reports the cost for a 10-kilogram case of cocoa has more than doubled, exploding from £60 to over £150. This surge in prices is a direct example of the UK's vulnerability to global supply chains. The UK is heavily reliant on imported food, and when there are disruptions like issues with the cocoa supply from Ghana, the shock is felt immediately on British high streets. The World Bank has noted that even as global food commodity prices level off, they remain nearly 40% higher than pre-pandemic levels, and import-dependent countries feel this most acutely. So what's the trigger? Economists are pointing to domestic policy choices, stating that recent increases in the minimum wage and national insurance contributions are being passed on by businesses directly to consumers. One chief economist at KPMG UK declared that Britain had become an outlier in recent months on inflation compared to other major economies. The situation presents a fascinating duality. On one side, the government's policies, like wage and tax hikes, are pushing business costs up, which contributes to what we call cost push inflation. On the other, the Bank of England is trying to pull inflation down by keeping interest rates high. It's like one foot is on the accelerator and the other is on the brake, creating a high-risk environment of economic stagnation mixed with high prices, sometimes called stagflation. This puts the Bank of England in a bind. An economist at investment bank ING called the figure certainly not good news for the central bank, saying the prospect for further interest rate cuts this year now hangs in the balance. And the challenge for the central bank is compounded by what's happening beneath the surface. We're seeing a two-speed inflation picture. While the price of some goods might be coming down, the inflation for services, things like hospitality, transport, and haircuts, remains stubbornly high. Research shows this services inflation is now the single largest contributor to the overall inflation rate. After all, headline inflation numbers can be misleading. For most households, the persistent rise in the cost of essential services is what causes the real financial stress, making it much harder for the Bank of England to justify cutting rates. But the comparison to its neighbours is what really highlights the problem. The UK's inflation is now significantly higher than large European economies like Germany, which recorded price growth of just 2.1%. This all leads to one critical, unavoidable fact for millions of households. With food inflation now officially outpacing average wage growth, families are getting squeezed. And here's what we need to watch for next. The biggest risk is that this squeeze leads to what economists call second-round effects. As workers see their purchasing power disappear, they will demand higher wages to keep up. While that sounds fair, it can kick off a dangerous wage price spiral where higher wages lead to businesses raising prices further, which in turn leads to demands for even higher wages. The Bank of England will be closely monitoring indicators like the Wage Growth Index and its Inflation Expectations Survey. The results of these will be a major signpost for whether the UK can get inflation under control or if it's digging in for a longer fight. So while UK households are feeling the pain of inflation, some big money investors are making moves to protect themselves. That brings us to our final story, which begins with a decision that caught everyone by surprise. A billionaire fund manager is now on the record with a stunning prediction. He says gold will almost certainly close above $4,000 before the end of this year, but the real bombshell isn't the price target, it's the portfolio advice. Jeffrey Gundlach, the CEO of Double Line Capital, is telling investors that a 25% allocation to gold is not excessive. To put this in perspective, traditional portfolio management, often called modern portfolio theory, typically suggests a very small allocation to commodities like gold, if any at all. The standard advice for decades has been the 60-40 portfolio, 60% in stocks and 40% in bonds. What Gundlach is proposing is a fundamental teardown of that model. And we're not just talking theory here. Real money is following this logic. For example, in just 1 week in August, the main gold ETF, ticker GLD, attracted a massive $2.3 billion in inflows. That led all other ETFs, signaling that large institutional investors are already starting to treat gold as a core part of their strategy, not just a small hedge. To be clear, a 25% weighting in a single commodity is a radical departure from conventional financial planning. Gundlach, whose firm manages around $95 billion, is effectively suggesting a fundamental rethink of portfolio construction. He's not just talking about a hedge, he's talking about a core holding. So what's driving this high conviction bet? Gundlach points to a trifecta of market forces. First, a weakening US dollar that makes gold cheaper for foreign buyers. Now, this isn't just about daily market fluctuations. There's a much larger structural trend at play, de-dollarization. Central banks around the world are actively reducing their reliance on the US dollar for their foreign exchange reserves. According to IMF data, the dollar's share of global reserves is gradually declining. And where is that money going? A significant portion is going into gold. The World Gold Council reported that in the second quarter of this year alone, central banks added another 166 tons of gold. For example, the National Bank of Poland has been a major buyer, increasing its gold holdings to over 20% of its total reserves. This trend is particularly noteworthy for Chinese audiences, as the People's Bank of China has also been a consistent buyer, recently adding 6 tons to bring its total reserves to nearly 2,300 tons. This provides a powerful long-term tailwind for gold prices that is independent of day-to-day market news. Second, the Federal Reserve's recent interest rate cut and signals of further easing, which reduces the opportunity cost of holding a non-yielding asset. So let's unpack that concept of opportunity cost. Gold pays no interest. So when interest rates on safe assets like government bonds are high, you're giving up that guaranteed income to hold gold. That's a high opportunity cost. But when rates fall, the income you're giving up is much smaller, making gold more attractive. The key metric to watch here is real yield, which is the interest rate after you subtract inflation. Right now, a key indicator, the 10-year TIPS real yield, has fallen to just 0.75%. This tells us that investors believe the Fed will have to cut rates more deeply to support the economy, which in turn makes holding gold a much more compelling choice. And third, the belief that inflation will remain stubbornly high, driven by the uncertain effects of tariffs. And here's where it gets interesting. We now have data backing this up. Wall Street traders are closely watching a metric called the five-year forward inflation expectation rate. It's a bit of a mouthful, but it's essentially the market's best guess for what inflation will be on average 5 years from now. That rate has recently climbed to 2.5%, which is significantly above the Federal Reserve's 2% target. This suggests that the market is losing confidence in the Fed's ability to control rising prices, especially with new tariffs adding fuel to the fire. When people expect their money to lose purchasing power due to inflation, they historically turn to gold as a store of value. He calls gold an insurance policy that has shifted into a winning mode, and the numbers back him up. The precious metal has already soared more than 40% this year, smashing its all-time high to reach $3,744. And if you think this is just institutional money, think again. Gundlach notes the rally has spread to gold miner stocks, a classic sign that retail investors are now jumping on the momentum trade. Now, if you want to track this yourself, there's a specific indicator analysts watch, the GDX/GLD ratio, which compares the performance of gold mining stocks to the price of physical gold itself. Recently, this ratio has surged, meaning mining stocks are outperforming gold. This often happens in the later stages of a rally when speculative interest heats up. It's supported by data from the CFTC, which shows that hedge funds and other large speculators have dramatically increased their net long positions in gold futures, essentially betting on higher prices. This suggests a powerful momentum is building, but it also increases the risk of a sharp correction if that positive sentiment suddenly changes. This isn't just another market forecast. It's a direct challenge to traditional asset allocation from one of Wall Street's most watched figures. With central banks easing and economic uncertainty on the rise, Gundlach is making a massive, concentrated bet that the ultimate store of value is about to enter a new golden age. So, what should we watch for next? Keep an eye on those key indicators. First, watch the real yields on 10-year TIPS. If they continue to fall, it will likely provide more fuel for gold's rally. Second, monitor central bank purchases and reports on the dollar's share of global reserves. Continued de-dollarization is a structural support for gold. And finally, watch that GDX/GLD ratio. If it continues to climb, it signals growing speculation, but if it starts to fall, it could be an early warning that the rally is losing steam. These are the focal points that will tell us if this new golden age is truly upon us.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.